Welcome, everyone, to Simple Mind Space. Today, we're diving headfirst into the world of real estate, specifically rental properties. Now, before you think this is some get-rich-quick scheme, let me stop you right there. It's not. Real estate can be a fantastic path to building wealth, but it's not for the faint of heart. There's work involved, and like any investment, it comes with its own set of risks. My goal today is to give you a clear, unfiltered look at both the good and the bad, so you can decide if it's the right fit for you. Let's start with the fundamental concept of how rental properties build wealth. It boils down to three key things. First, you're renting out your property to tenants. Second, those tenants pay you rent, ideally enough to cover your mortgage payments and other expenses. Finally, as you receive rent and pay down your mortgage, your property is simultaneously appreciating in value, meaning it's increasing in worth over time. This potent combination is what fuels your wealth-building journey in real estate. Now, let's get into the nitty-gritty, the math behind it all. Imagine you have $30,000 ready to invest. You could put it in the stock market, park it in a savings account or a certificate of deposit, CD, or you could consider a rental property. Let's compare. Say you decide to use that $30,000 as a down payment for a $300,000 rental property. Assuming a 30-year fixed-rate mortgage at 4% interest, your monthly mortgage payment would be about $1,289. Factor in property taxes, insurance, and other expenses, and you're looking at roughly $1,139 per month in total costs. Now, if you can find tenants willing to pay that amount or more in rent, you're essentially having them cover your mortgage. Fast forward 30 years, and you've paid off your mortgage, owning the property outright. But here's the kicker. During those 30 years, the property itself has been appreciating in value. If we assume a modest appreciation rate of 4% per year, your property could be worth a whopping $973,000 by the end of that period. You've essentially transformed your initial $30,000 investment into nearly $1 million. That translates to roughly a 12% annual return over those 30 years. How is this possible? It all boils down to the power of leverage. When you invest in real estate, your returns aren't just based on your initial down payment. Instead, they're based on the entire value of the property, which is significantly larger. It's like riding a wave. A small push at the beginning propels you to much greater heights. Now, some of you might be thinking, but what about inflation? Will $973,000 in 30 years be enough? And it's a valid concern. But here's another way to look at it. Owning a rental property is a hedge against inflation. As inflation rises, so do property values. So even if inflation is high in 30 years, your property's value will likely have kept pace, providing you with a valuable asset and financial security. Let's contrast this with the more traditional route of investing that $30,000 in the stock market. Even with an optimistic average annual return of 10% over 30 years, and ignoring any taxes on gains, your investment would grow to approximately $523,500. While impressive, it's still significantly less than the potential return from the rental property. This is not to say that real estate is a guaranteed home run. There are risks involved. Bad tenants, unexpected repairs, vacancies, even a housing market crash. These are all possibilities. But it's important to remember that the stock market has its own set of risks. The point is, real estate, when done right, can be a powerful wealth-building tool, offering potentially higher returns than the stock market. Now, I know what you're thinking. Okay, it sounds good in theory, but how do I actually make this work in the real world? Well, that's where my experience comes in. Over the years, I've learned a lot, made my fair share of mistakes, and developed some crucial tips that I wish I knew when I first started. Here are 10 essential tips to help you navigate the world of rental properties and avoid costly mistakes. Protect yourself with an LLC. Forming a limited liability company, LLC, is crucial for shielding your personal assets from any liabilities that may arise from your rental property. It creates a legal separation between you and the business, minimizing your personal risk. Get landlord insurance. Don't rely solely on your tenant's renter's insurance. Landlord insurance provides specific coverage for your property and liability protection in case of accidents, damage, or lawsuits. Thoroughly screen tenants. Finding good tenants is paramount. Thorough screening, including credit checks and background checks, can help you weed out potentially problematic renters and save you immense headache down the road. Be prepared to handle tenant issues. Dealing with tenants is part and parcel of being a landlord. Whether it's collecting rent, handling maintenance requests, or addressing complaints, being responsive and proactive is key to a smooth rental experience. If you'd rather outsource this, hiring a reputable property management company is an option, though it comes at a cost. Act swiftly with problem tenants. Don't let issues with tenants fester. Address late or unpaid rent, lease violations, or property damage immediately. Time is of the essence, and taking swift action, even if it means involving legal counsel, can prevent small issues from snowballing into major problems. Understand security deposit laws. Familiarize yourself with the specific security deposit laws in your city or state. There are often strict regulations regarding holding, returning, and handling interest on security deposits. Non-compliance can lead to legal repercussions and financial penalties. Find a good deal on your property. The success of your rental property investment hinges on finding a property with good potential returns. Don't just settle for any property. Analyze the numbers carefully, including mortgage payments, property taxes, potential rental income, and all other expenses to ensure a profitable venture. Build and maintain a good credit score. A good credit score is crucial for securing favorable mortgage terms and interest rates. Lower interest rates can significantly impact your monthly payments and overall investment profitability. Don't fear taxes. Many new investors get intimidated by the tax implications of owning a rental property. However, reporting rental income and expenses on your tax return is fairly straightforward. Moreover, there are numerous tax deductions available to landlords, such as mortgage interest, property taxes, depreciation, and repairs, which can often offset rental income and minimize your tax liability. Plan for long-term tax advantages. There are significant tax benefits to holding onto your rental property for the long haul. Consider strategies like a 1031 exchange, where you can defer capital gains taxes by reinvesting profits from the sale of one rental property into another similar property. Alternatively, holding onto your property until death can allow your heirs to inherit it with a stepped-up tax basis, potentially eliminating capital gains taxes altogether. Real estate investing, especially in rental properties, can be a fantastic way to build wealth over time. It's not a passive income stream, but with the right approach, due diligence, and these crucial tips, you can set yourself up for success. Remember, it's not just about the numbers. It's about diversifying your portfolio, creating financial security, and achieving your financial goals. If this resonates with you, I encourage you to explore real estate further. Educate yourself, seek guidance from experienced professionals, and most importantly, take action. Thank you for tuning in to Simple Mind Space. If you found this episode valuable, please hit that like button, subscribe to the channel, and share it with anyone who might benefit. Until next time, keep striving for financial freedom, and remember, your potential is limitless.